You're listening to the Quint's podcast.
The second wave of COVID-19 cases in India has brought back fears of a pause in economic recovery, with Dalal Street taking a hit as investor sentiment dipped. On 12th April, Sensex lost over 4,400 points from a record high of 52,516 on 16 February. Nifty, on the other hand, fell below the 14,600 mark against a record high of 15,431. Investors are spooked over the fact that the states impacted by the second wave contributes significantly to India's GDP. Maharashtra, the worst hit state, contributes 13.7%, Karnataka 8%, Gujarat 7.8%, Rajasthan 4.9%, Madhya Pradesh 4.2%, and Punjab at 2.7%. What is more worrisome is that it just took 47 days for India to cross the 1 lakh daily COVID-19 cases mark, compared to the first wave that took us 102 days to reach the peak. The Indian market has been witnessing strong bouts of volatility since the beginning of March when the cases started spiking again. So, should the retail investor be worried about the money they have parked with rising cases, or is this just another opportunity to buy low and sell high? To break down what these rising COVID cases mean for the retail investor, for today's episode I sat down with Neeraj Shah, the markets editor for Bloomberg Quint, to discuss where the markets stand at the moment and the way forward. You're tuned in to The Big Story, the podcast where we dissect the headline-making news for you, and I'm your host, Himmat. So first, thank you so much for making time for us today, sir. And my first question is that for somebody who has been analyzing and reporting on Indian stock markets from the health throughout this year, I wanted to know first where the Indian markets stand at the moment compared to other markets. The markets did get a boost from what was hailed as a really good budget and was almost being as an unheard of budget. But given the uncertain times that we're in right now, where would you rate the markets to be?
Okay, firstly, thanks for having me here. You have to agree that the budget was actually a bit of a landmark budget, and other things remaining constant, maybe the markets would have been in a much better shape than where they are right now. Though you also have to agree that post this slight uptick that we've seen yesterday, we're still not in despair territory. We probably were off about 8% from the highs, which is fine. Now, if you compare it to the US, where vaccinations are really ripping through the roof, where the economy is going gangbusters, yes, India shouldn't be at all-time high levels as where maybe the US should be. But remember, we are also an economy which has done whatever it has done without any major stimulus, save for the PLI schemes and some of the others that have been announced. Yeah. So we're probably at fair value, if you will. Maybe a bit of a corrective move could come in or should come in if the cases go up, because people and investors in particular will be a bit wary of putting in large blocks of money when cases seem to be rising. But I don't think that's the real trouble, really. I don't think COVID-19 cases rising is the real trouble for equities at large.
Okay. Now, speaking of COVID-19 as well, like the next thing I want to talk about was the crash on Monday. So Sensex lost over 4,400 points from a record high at 52,516 on 16 February. And the Nifty also took a plunge below 14,600. With this sudden spike of cases that we are witnessing right now, like, should individual investors be worried? Because this is where their money also lies, and that's a big risk for them. Or is it too prudent to read too much into these crashes right now?
So, the funny thing is most people that I would speak to would say that you should discount a few months out, right? So if you think back to March 2020, on the day when the lockdown was announced, was in or around that time is when we hit the bottom for the markets, and then the market started rising. So should we be unduly worried about these rising cases? As a tactical trader, sure, you should be worried. So if you have leverage, yes, you could be worried currently, because if the cases spiral, and I presume we are still to see the impact on the numbers of Kumbh as well as the election rallies, and if all of those numbers rise, could they worry the markets and investors? Sure, they could. Monday was a classic example of that. I don't think anything else really changed. The global markets are also placid, but Indian markets corrected, presumably because of the high numbers and the fears of a lockdown. Now, if multiple states lock down activity for a period of 2 weeks, 3 weeks, 4 weeks, and we don't have a handle on the vaccination, then it's a worry for sure. And for tactical traders, yes, we could correct. But if you're a long-term investor, maybe you should welcome that correction, because frankly, these markets need a bit of a correction for some value to emerge. And maybe this is the reason why some long-term investors will get better prices to invest into.
Okay. But for short-term investors, this is could be a worry, like if I'm reading it.
Yeah, you are reading it right. I mean, there is a case for being a bit cautious, because the markets could go either direction from where we are right now. And therefore, you might well think that the markets are going to go down, but there might be a flash up move the way it happened today, right? 1.5% ahead of a holiday, 1.5% uptake. So that could well happen. And there is a very large case for the markets to correct a bit if indeed multiple states, as I said, go for a lockdown. But let's see, Maharashtra's announcement might come in maybe Wednesday evening, if more mills and some channels are to be believed. So it is a worry for the near-term trader, yes.
Yeah. Okay, the next thing I want to talk about is the Indian rupee as well, which is now trading at a 8-month low, plunging below 75 against the US dollar for the first time in the past 8 months. So what kind of bearing and repercussions would this have on stock markets as such?
Yeah, you would want to believe that the markets would think that the fall in the rupee is a reflection of what's happening on the part of the foreign institutional investors, and not just in the equities but also in the bond markets. Remember, until last week or the week before last, FIs were heavily buying into the debt markets. There is an impending event of the inclusion in the MSCI, right? So that will actually be a great thing for the Indian bond markets. But I think FIs have been net sellers in the last maybe few days. And Monday was a reflection of that, right? You saw a large plunge on Monday, both in the equity markets and the currency, which kind of slipped to almost 75. So I think I would think it might be naive really for somebody who tracks equities to comment on what the currency will do in the very short term. But I would presume that a lot of this is linked or joined at the hip to what's happening in the fears around COVID and the vaccination. If indeed the vaccination things go okay and the confidence of the foreign investor comes back for both the debt and the equity markets, then you might well see some of these corrective moves on the currency start to reverse a little bit.
Okay, so what I have seen so far is that whenever the markets lose, the gold prices go up. So is gold or silver a good investment to have right now?
Now that's a tough one for me to answer, to be honest. I would presume from whatever little I learned, so I'll essentially quote people. This is not a personal opinion that I have, but the Indian housewife is the best barometer of what to do with gold, right? All through the years, we've been fabulous investors.
I love the perspective at the moment in my life, but it's
yeah. So a lot of my personal wealth is because of the gold and silver that was given to me on all the Diwalis and the New Year's and birthdays, really. But on a serious note, it could do well. Precious metals, they're a good hedge. And if you believe, as everybody is saying, that inflation on its way up around the world, not just in India, then you might believe that gold prices are headed up. Well, to an extent, because of higher acceptance and the fears around inflation, you're seeing what's happened to some of the cryptos. No reason why gold may not. But the jury is out there, really. A lot of people also believe that some of the money that could have gone into gold is going into some of these cryptos as well. So frankly, the jury is out. I would presume that gold should or would see some buying, silver would see some buying. A lot of reports from global banks, Danske Bank, Saxo, etc., are all talking about why gold should be bought into lock, stock, barrel currently. So they believe certainly that gold should be bought into. This is international gold, but I'm presuming the same holds true for India.
So the question is, what is the correct investment strategy in such uncertain times? What are the investor favorites at the moment?
What is the correct investment strategy? I think the only investment strategy is buy low and sell high.
Okay.
Right? Everything else is noise. But within that, I mean, it's easier said than done, right?
Yeah.
And at 14,500, there are very few opportunities that you have to buy low. And now, if you analyze, or if you even partially look at any conversation, whether on Bloomberg Quint or for that matter anywhere else, I'm not telling you to only look at Bloomberg Quint conversations, or almost every conversation, every expert would tell that this is a great time to get into domestic cyclicals. By domestic cyclicals, I mean all of those cyclical sectors that derive their business out of the Indian economy, selling to the Indian economy and not exporting. Right. So everybody is saying that go into domestic cyclicals for two reasons. One, that if the economic growth were to pick up, then these businesses would do well. But two, the other very important reason is that there is valuation comfort here. A lot of these domestic cyclical sectors are not trading at the valuations at which the export-oriented companies are trading at. So, for example, TCS, Infosys, etc., are trading at valuations that are the highest that they've traded at. But the banks, which form a part of the domestic cyclical space, are about 10, 12, 15, 20% cheaper depending on which bank you choose. In certain cases, PSU banks have lost almost 50% from the recent highs. So banks are cheap. So there is perceived value here in the domestic cyclicals, and which is why you see a lot of people saying that get into those sectors, some of those, not all, because the downsides would be protected. And as the Indian economy rebounds, which we all hope it would, and in all probability it should, given the impetus around manufacturing, you'd probably see some of these come back. The other bit is, by the way, is manufacturing, right? With so much of impetus given to manufacturing, there could well be a lot of high quality manufacturing companies which could do well over a period of 2 years. And the advantage again out here is that you're buying low and you're selling high. If you sell, of course, but you're essentially buying low. You're not buying very expensive names currently. And that's probably not bad advice.
Okay. So
just an add-on out here, Himmat, if you will.
Yeah, sure.
This doesn't mean, though, in my personal opinion, that some of the global cyclicals are bad investments. Frankly, a lot of people who have looked at Indian IT, for example, over many years, come out and say, we did a webinar on Saturday for Bloomberg Quint subscribers with a firm called White Oak, which manages about $3 billion. And the two people who track information technology very closely made a presentation which almost made a very compelling case for being invested in IT for the next 10 years.
Wow.
Now, depends on the kind of investor you are. Yeah, I mean, their call is that we're probably looking at double-digit growth for at least the next decade for Indian IT. And these companies' margins are high, free cash flow is high, they pay out a lot of dividends, etc. So therefore, and corporate governance is very strong. So there is a compelling case for some of the global cyclicals or global exporters also to be bought and kept in your portfolio. But largely, the call should be that if you don't track the markets on a day-to-day basis and you're not an expert on valuations, then try and buy low and sell high.
Yeah. I was watching your interview with Taimur Baig from DBS as well, and he mentioned the growth of Tesla over the past 10 years and how it has jumped up. So, I was just like perplexed on that as well, just watching that.
Yeah, Tesla perplexes everybody, so you are not alone. I'm sure Taimur himself is perplexed by what's happening to Tesla. So, I mean, it's a fabulous story to say, but ask anybody to give a half an hour presentation on Tesla. Yeah. And I've seen a lot of people give fairly rudimentary and poor presentations out there. So, it's okay.
I just saw the image of the graph just going up, being at the bottom, just going up in 2020. So,
but imagine, Hemant, before you ask your next question, just imagine that at a point of time on the Bloomberg terminal, there were charts which were comparing the rise of the prices of Tesla and the rise in the price of Bitcoin and how the two were so correlated.
Yeah.
Now, that's something.
That is something. Okay, I also don't want much of it evening now, afternoon now. So, seeing the markets plunge as they did yesterday, many people, including me to some extent, were thinking that this is the right time to enter the market, to enter the stock market or to start investing. So what advice would you give to anyone who's a new investor just seeing this crash? Are there any red flags that they should be worried about or should be consciously aware?
So, Himmat, as boring as this may sound and as easy as this may sound, but if you're a new investor or if anybody who's listening is a new investor, that person is not necessarily going to be able to time his investments to the exact point, right? It's just impossible even for experts to do it. So the new investor, it's impossible. So the new investor should come into the markets with money that she or he can keep invested, let's say for 5 years. Let's say, argument's sake, it should be for longer, but let's say 5 years. So if you're buying for 5 years, then you should actually welcome all the crashes that come, because at every single time that the markets crash, you get to buy the same high quality stock that you want to buy at a lower price. However, I must say that if you are, I know a lot of people have gotten into individual investing into stocks, and it's not a bad thing at all if you can devote some bit of time and not buy the random tip that your neighbor uncle is giving you. But otherwise, there are, as boring as it sounds, again, I'm repeating, there are some really high quality mutual funds out there, not just the large ones, the small ones, which have given XIRR, which is the SIP equivalent of CAGR. CAGR is the compounded annual growth rate, which means the rate at which your investments grow every year. XIRR is the rate at which your SIP grows annually year after year, right? So because you are doing an SIP, you look at the XIRR number. There are a bunch of very high quality mutual funds which over the last 5-6 years have given an XIRR run rate of 20-22%.
Okay.
Trust me, it's almost impossible to beat that. So if you do not have the time to be able to monitor the markets daily, and if you don't want to be satisfied with the Marutis and the HDFC banks of the world, which are large and boring, then you should maybe choose a mutual fund. But if you have the time, then sure. The multiple brokers out there who will give you an account for free. The trading is free or the investment is free. And sure, go out and park a little bit of your money out there. Take a little bit of risk, because if you're a new investor, you're presumably young in age. And if you don't take the risk right now, then when will you?
Exactly. That's what my father keeps telling me.
That's sound advice. Always listen to your father.
Well, thank you so much for your time today. It was a pleasure talking to you. And also
thank you.
Understanding the crash as well and what it means for individual investors. Because
celebrate crashes, Himmat. That's the limited point I'm making. If you're a long-term investor, celebrate crashes because they give you a chance to buy low.
Great. Thank you for that great advice. And if you want any more advice, you can always log on to the Quint and Bloomberg Quint for all your financial needs and advice. Thank you so much, sir, for your time today.
Thank you. Stay safe, everybody.
If you liked listening to this episode, please subscribe to The Big Story for episodic updates. We're available on Apple, Google Podcasts, Spotify, JioSaavn, and most of the other popular podcast streaming platforms. For other podcasts, please log on to the Quint website, and for any feedback, please shoot an email to podcast@thequint.com.
Thanks for listening. Log on to the Quint's website and check out our other podcasts.